All right, so first thing I want to do is thank our sponsors. So if we call your name, if you could raise your hand, please. Lapata Fliegel, Mike couldn't be here. Is there anybody from Lapata here today? No? All right, moving on. David Parkside, right here in the front, if you could raise your hand. Thank you. Grant from Atomic, standing up in the back. We got Jason over here on the camera and the live stream from SWIP Systems. Tom from Black Twig, where you at? Thanks again for helping out this morning, bud. Jamie from CMA. Jamie, are you here? Nope. Oh, that's right. She's out of town. Paul from Polsinelli is going to be presenting today or moderating the panel. And then Matt from Scarin Insurance, where you at, bud? In the back. Thanks again for helping out this morning. Thanks, you read my mind. They make everything happen. The food, the chairs, the panel, everything, the room, the microphone, everything. So let's hear it again for the sponsors, please. There is a table in the back with some good information. If you want to walk by there, there's a sign, please support our sponsors. It's our whole goal to help them in any way that we can. We have a huge announcement this morning. So as some of you know, we've been doing this for 12 years. We started off with an online LinkedIn group, and then we moved to this in-person group. Number one, the 2025 dates are on the website, mmlgroup.org. So if you go to upcoming events at mmlgroup.org, you'll be able to see all the 2025 dates all laid out. But the big announcement is our LinkedIn group passed 10,000 members this week. So thank you to all of you for that and making that happen. As I've mentioned in the past, we're in the Inner Circle program for LinkedIn, recognized as one of the top run groups worldwide. So there's a card in the middle of the table. If you're not a part of that MML LinkedIn group online, please jump in and join the conversation. So we got a fantastic panel today. I can't wait to hear everything that comes out of this. Paul Klug from Polsinelli is going to be moderating today. So we're going to let everybody introduce themselves as we kind of go, and I'll pass this over to Paul.
Hi, good morning, everybody. My name is Paul Klug. I'm from Polsinelli. We have a great, I'm not going to talk about myself because we got the panel here, and this is why we're here today. For those of you in the room who know at some point in time you're either exiting a business, you might do something any transactionally related. These are the folks. We tried to bring a different perspective from each of these chairs. We have Brian Salmo, who brings the family office background. We have Adam Bennett. Sorry, you guys are out of order here. We have yeah, I'm out of order. We have Adam Bennett, who brings a private investment fund perspective. Huels, private equity, and last but not least, Patrick Nolan, investment banking. So I'm gonna kick it off, ask a few questions, but I think a little bit different. Sometimes we hold the questions till the end. We're going to do a little bit different this morning. If you'd like to ask a question while we're going through the panel and some other questions that we've set up, please just raise your hand and we'll try to catch you. Or just wave your hand and we'll try to do that. So interactive, try to get this going. I'm going to kick it off with Brian. Well, first of all, I'm going to let each of them just for 30 seconds or so introduce themselves. Go ahead.
Do I need a mic?
Yep.
Here. Okay, thanks. Thanks, Paul. I'm Brian Salmo from Hermann Companies. As Paul mentioned, Hermann's a single-family office. Our principal is Bob Hermann, who had a distribution business and a manufacturing business that he exited and then decided to diversify and start Hermann Capital Management, which is where I work, and we do investments from credit investing all the way down to equity and everything in between, which we'll talk more about. Been with the firm for about 3 years. Before that, I had several roles at LMI Aerospace and started my career working for Paul as a corporate attorney at Polsinelli.
I didn't know that.
Yep. Well, small town.
Adam Bennett. I run Bennett Capital Partners. We focus on investing and acquiring family-owned businesses, mostly in the industrial, manufacturing, distribution, service space. I've worn many different hats in my career, but I grew up in a family business. My family owned a wooden door manufacturing business in Springfield, Missouri. So I always kind of think of myself as a family business operator. But my career took me into being a merger and acquisition investment banker. So I did what Patrick does. I spent 3 years with a mezzanine private equity fund in Boston. So I kind of wore the hat that Holly wears. I was at a buyout fund focused on family businesses. And then all it kind of culminated in 2009. We sold our family business to a public company in Sweden called Assa Abloy, and I led that transaction for our family, and that's really what was the genesis for starting Bennett Capital.
Thanks, Adam. Good morning. My name is Holly Huels. I'm founder and managing partner of Holleway Capital Partners. We are a private equity fund in Clayton. We have a pool of committed capital that we make investments, control investments in lower middle market manufacturing and distribution businesses in the middle part of the country. So those are companies typically $2 to $10 million of EBITDA, where an owner is, most commonly an owner is aging out, where the management team is in place running the business and wants to remain with the company, but the owner needs a succession plan. So we're providing financing, junior capital, and equity to allow the owner to transition out, but for the family business to remain operating and independent versus a sale to maybe a strategic buyer or some option like that. But I had 22 years with a private equity fund here in St. Louis called Capital for Business, affiliated with Commerce Bank, before a partner and I broke away in 2017 and launched Holloway in 2018 as an independent fund.
Thank you. Good morning. My name is Patrick Nolan. I'm president of Nolan and Associates. We're a boutique investment banking firm based here in St. Louis. And we play two roles primarily for our clients. One is we help founders and family-owned businesses go through the sale process. So we'll take them to market and help them extract the best deal and partnership that the market has to offer. And then on the buy side, we work with groups like Holly's and large corporates that are looking to make acquisitions in certain categories. So we've got 16 folks on our team. We've been in business for almost 50 years, and a lot of familiar faces around the room. So good to see everybody this morning. Thanks.
There we go. All right, thanks everybody. Well, we'll unless anybody wants to raise their hand right now, we'll go ahead and kick it off with a question here for Brian. Brian, what are the big differences between bank financing, PE, family office, other financing sources?
So I'll address that in very broad kind of generalities, and anybody else can chime in and put more nuance on it too. From my perspective, bank financing, and probably everybody in the room is pretty familiar with it, whether for your business or personally, but generally it's going to be debt. Probably the most favorable interest rate you'd receive for expected return. Probably not trying to control your business, although they'll have covenants. But that's bank financing. So then you move on to private equity. They're probably looking for a control position, meaning the right to change people and set the strategy. They're likely looking for an exit in some time horizon, 4 to 8 years maybe after they get in, and they're going to have very strong expectations of growth and return. So that makes a lot of sense for a lot of people, but it depends where you are maybe in your career and expectations. Then enter where I spend my time, family office. It's a little bit of everything, or it can be, and it's really centers around the principal or the family expectations. So in general, though, family offices can provide loans similar to a bank. They can provide junior debt, so maybe higher interest loans that are a little riskier. They can provide growth equity, which is generally where we play. Hermann, we don't look for control positions. We look for minority investment with a strong management team in place to keep doing what they're doing, and our capital comes in to fuel some growth and maybe for the owners to take some money off the table. But I'd say those are the highlights from my perspective.
Anybody else want to comment?
So far, so good?
Okay.
All right, keep it rolling.
So yeah, Brian did work with me, so that's why it was such a good answer to start. I won't claim credit, but we'll go over to Holly, and so we talked a little bit about the different what each of these could bring from bank to PE. Holly, when do you see the opportunities to bring either debt or equity in a growth situation?
Private equity is typically a little bit more transformational to a business, as As Brian said, almost every company has some kind of bank debt or access to credit when they get of a certain size, especially manufacturing and distribution businesses. The banks have an appropriate interest rate. There's often a personal guarantee. There's often the banks are looking for collateral beyond just the physical piece of equipment you may be buying. They're looking to for secondary and additional sources of repayment if the company can't repay the loan. Private equity is most commonly used in a situation where, at least for our version of private equity, is when something transformational is happening to the business. Either it's a small business, and for us small is kind of 2 to 10 million of EBITDA, is doing a significant add-on acquisition, something that a bank wouldn't do independently by itself or as the sole source of capital, and new capital needs to come in. Or more commonly for us, where there's someone aging out, or there's an ESOP that's wound a little bit too tight, or some kind of a situation where succession needs to happen. So there's I would say least low risk, not giving up any equity, source of repayment is the company, is appropriate place for a senior lender. But as you need more junior capital, mezzanine capital is a little bit more expensive, typically comes only with a small amount of equity, minority position, and really when something much more transformational is happening is when you might look at private equity as an option.
Okay. Anybody want to comment? Nope. All right. So Patrick, I'll punt it over to you so everybody gets a shot here. So some of the folks in the room, if they're contemplating, maybe a potential exit or a transaction involving somebody here, they call you. What's some of the advice you give off the bat as far as things they can do to get their company ready, things to expect from a diligence perspective? What do you see?
Yeah, so I think generalities here again. I would say be prepared for a Q&A session like you've never had before. And the due diligence process through a sale is extensive. The buyer is looking to learn as much about your company as possible to make sure they're not stepping into any traps. You'll be asked the same question multiple times from 8 to 10 different parties that are involved in due diligence, and it can be completely annoying. So I think just getting your mindset for, okay, this is going to be, someone's going to pay me a lot of money for my business, and I'm going to have to produce the necessary information in order to achieve the transaction. And one thing that I think most companies, particularly manufacturing companies, that we would love to see have prepared when they come to a process is just clean data. So on the financial side, obviously that means your financial records are historically intact and accurate and represented by a third-party CPA firm. But probably as importantly or more importantly is just the tracking of your internal data. So putting systems in place where you can track your gross profit margin by product line or by customer or by industry category or by sales channel. And you can do that in a pretty timely fashion because you have the systems in place to do so. That will pay dividends 10 times over when you go through a sale process, because the demand for data and the demand for timely data in the process is extensive, and the ability to be able to produce that for any set of buyers is going to impress them and give them the confidence to be able to bid strongly on your business.
Go behind here. So Adam, I'm going to take it from a little bit different perspective. Things to look for, as Patrick mentioned. What are some pitfalls that you see? If you were, I know you've been through an exit. What would you say to business owners? Avoid these pitfalls if you think your company's going to need financing or some sort of source of funding from somebody like you.
I'd say first, everything that Patrick just said was spot on. That was the exact thing. The worst thing we get when we look at a material, if the advisor hasn't prepared it in a way and we spend months going through the financials only to find out that they're not right. I mean, not only we wasted your time, but it doesn't set a good precedent for trying to get a deal done. I would say the biggest pitfalls is someone calls Patrick and says, hey, I want to sell tomorrow. And Patrick says, well, what have you done, for the last 12, 18, 24 months to be ready? The best advice that I have is going through the process as if you're going to sell, but do it 2 years before, right? You talk to someone like Paul. When I look at a business, if you don't have audited financials, it's very tough for me to sit there and say, okay, this is gonna go smoothly, this is gonna be accurate. I know it costs more, it's a pain in the butt to do audited financials, but do it. It's well worth it if you're gonna think about selling. I would talk to Paul or someone like Paul and say, what is the diligence? You see, we get, pages and pages of questions. The Excel sheet that I send to prospective people is massive. That's IT, that's HR, that's everything. So make sure you are thinking about where you want to be down the road and preparing now. The other thing that we look at is the culture and the people. Have you invested in the systems? Have you invested in the equipment? And are we going to step into a situation where your EBITDA is X, but gosh, I'm going to have to spend a few more $1 million to upgrade whatever I need to do. So I think those are some of the pitfalls that people don't do that are really key to making sure that it is a smooth process.
Anybody else want to comment? We're good? Okay. Just to shift gears a little bit, we kind of dove into the weeds a little bit right away on some things the business owners need to know. I'm going to let you guys just go down the line on this one. Post-election now, just kind of get your guys' thoughts on the M&A markets, what's maybe in store for the end of the year. Is it going to be a busy end of the year? How does 2025 look for you guys?
So my comments will be just before Election Day, kind of how we were looking at the world, because I'm not sure we have a distinct difference yet in perspective. Our view inside of Hermann and how we're looking at the world, we have a balanced, diversified portfolio, but we're definitely trying to figure out what are the sweet spots to where to put money to work today. I would say consumers are pretty tapped out when you look at the amount of debt they have. Interest rates don't appear to be dropping that quickly. So that's definitely a concern, especially relative to multiples being at peak levels, and they've just gone up, or valuations have just risen in the past few days since the election. So we're definitely concerned about valuations. The consumer and their ability to demand more and spend more, we don't see clearly where that's going to come from. With that said, you got to go to work, you got to run a business just like everybody in this room does every day through the cycles. So one other note, and I think Adam touched on it somewhat, but we look at the depreciation as real CapEx that should be spent when going into a business. And why I bring that up in this context is with interest rates being higher, EBITDA looks great. In a lot of companies we evaluate, they've been able to pass through price increases, and so EBITDA and gross margins and bottom line margins are very high, but the I is real, the interest charge is real, and also the depreciation is real. And so have people been reinvesting those profits back in the business, or were they swept out? So that's where I get a little skeptical with, will prices stay at this level based on where consumers are? Interest rates aren't apparently dropping as fast as some expected, and did the owners continue to reinvest in the business and support the depreciation amortization charges? So getting below EBITDA a little bit.
We're
just going down the line?
Yeah, just to get your guys' perspective.
My first thought that came to my mind was giddy up, man. It's going to be crazy for the next 4 years, right? There's been so much pent up, people just the uncertainty, not wanting to transact. Geez, depending on who wins, I'm going to have to rearrange my estate planning. Do I sell? A whole bunch of uncertainty. And I think people have a pretty good idea of what's coming. And so from my perspective, we need to think about what those changes are going to be. We have one of our businesses, we import a lot of goods from China, right? How does that, impact us? What are we going to have to do to adjust that? How do we, figure out ways to mitigate some of that potential risk. When I say potential, I mean it's coming. And on the flip side, on the interest rate side, I think people are just realizing this is going to be the new normal. I agree with you. Rates probably aren't going to come down as much as people thought. We had the 50 bips a little while ago. Yesterday, the 25 bips. But people are just, I think, going to start accepting that. Private equity funds are going to say, look, this is my new borrowing cost, and this is how I'm going to think about. And people have tons of capital to put to work. The private equity market is sitting on billions of dollars of dry capital that they need to put to work so they can go raise another fund. So I think, and Patrick probably have a better view on this than I do, but I think you're going to see a huge unlocking of deal flow very, very soon.
Agree with everything they said. I think everybody expected 2024 to be better than what it has been. We came out of 2023, I think people thought 2024 was going to be the kickoff of a strong deal flow, strong deal activity, and it's turned out to be quite a soft year, I think, just generally. We think the second quarter was strong, and then as the third quarter, as people knew the election was coming, things had slowed down. But our portfolio is exclusively manufacturing. We've seen some general softness across the manufacturing sector or across our portfolio in 2024. We've had a couple of really bright spots of people who have strong backlogs and can see pretty far in the future, mostly our capital equipment companies. But I would say there's been some stepping down in 2024. But I would say, given the election and kind of all of our companies are U.S., we don't really have much reliance on China at all. Most of our companies are domestic. Well, they're all domestic manufacturers, and they almost all have domestic sources of supply, so or non-China based supply. So I think, but tariffs are going to be real. I think people are going to really have to adjust, and once President Trump is confirmed, what's the word? Ordained in January. He will, I think there will be, it will be good for the manufacturing sector in the U.S. I think there'll be some continued reshoring that we have begun to see in our portfolio over the last few years. So I think generally the outlook for 2025 and beyond, I think we need to see some profitability rebound in the portfolio. I completely agree with Adam. There is a constipation as far as portfolio equity, private equity funds have portfolio companies that are ready for sale as profits begin to rebound, as the election now was determined, and as we move into 2025. I think 2025 and beyond will be a really strong. But the interest cost, I completely agree, is real. And what private equity firms have had to figure out is just because you bought it at a certain EBITDA multiple when interest rates were low, maybe a high multiple when interest rates are low, you might have to sell it at a slightly lower multiple because interest rates are higher, because that is a real cost for all of us as we are buying and selling companies. So I think the market is going to have to realign what high multiples mean going forward versus what people have been maybe willing to pay in the past when interest costs were lower.
Not too much more to add. You guys covered it. But one thing that drives our business, particularly dealing with families and founder owners, is just any sort of tax implications that might be on the horizon. So leading up to the election, there was quite a bit of concern, particularly around the estate tax piece sunsetting. I think people were trying to get ahead of that into 2025. I guess I'm not sure what will happen with that at this point, but I think that could maybe accelerate some people's plans a little bit in pursuing an exit. And then I think that the tariff thing is going to be opportunistic for U.S. manufacturing, and that should hopefully drive both revenue and profits for companies like yours, but also it'll drive investor interest as well, which should hopefully push valuations up for U.S. manufacturing too.
All right, thanks. A follow-up thought.
There you go.
One more thought, particularly for everybody in this room. I think it's pretty common where each of us operate in, I'll call it the lower middle market, where good operators are the rarest commodity and most valuable commodity. Everybody up here is looking for somebody that knows an industry, that can operate in good times and in tough times, and wants to grow. second point related to that is when I talk to other people in the lower middle market, other investors, in the past year, I'll say that the tone has changed for some of the reasons we mentioned about interest rates and otherwise, more competition from funds. But the lower middle market, what we call the multiple arbitrage, or hey, we combine two companies and you get a bigger multiple because there's more EBITDA, that opportunity has diminished. And what the people in the lower middle market need to do when they buy these businesses is really add value. So I think a lot of private equity funds are in tune with that and try to have operating executives across, whether it's operations, marketing, et cetera, to help the portfolio company, the company they invested in, your companies, get to the next level so that next bigger buyer is there and whatever the time horizon is. But I've just heard a lot more discussion among investors around operating performance, having great operators on the team that they're investing into, and having to improve the business rather than just saying we're going to do some M&A, put things together, and voila, we'll have multiple expansion and we'll all get paid. It seems like everybody in this room who operates good businesses that can be bigger with the right capital are the most sought after commodity out there.
Anybody else? I'm going to go back down to Patrick here. So Patrick, somebody in the audience comes to your office and says, okay, it's time for me to consider about exiting, and you have various alternative potential buyers. Maybe 3 of them are sitting here on the panel. How do you approach or characterize potential buyers for them, and what's your advice to them when they're looking?
So we broadly categorize buyers into 2 buckets. One is the strategic buyer. It's someone that's in your space or on an adjacent industry category where they're going to combine the acquisition of your company into theirs. And then we talk about financial buyers, which are private equity groups, family offices that are looking more from an investment or a platform investment standpoint. Directing you to one or the other is dependent on goals and objectives, right? So if you say, I want to take some chips off the table, I've got a great business, but I can see the next 10 years of this business being even greater, I'd love to secure my net worth and diversify, but keep a good chunk of the business. That's a financial buyer, whether it's private equity or family office. If you say, I want to go to the beach tomorrow, and spend the money that I'm going to get from this transaction, that in a lot of cases that's a strategic buyer. There are financial buyers that can solve for that, but a lot of times that's going to help us direct traffic on where we go in the process. And then when you get down to who do you of the 2,000 private equity groups or financial buyers out there, how do you narrow it down to the right groups for your circumstances? And part of that's the size of your business, part of that's the industry you're in, the geography of your business, and then also comes down to kind of, you won't probably learn this until you get into the process, but the partnership perspective, right, the cultural fit and all that is usually a pretty big deciding point for our clients on who they go with. The economic terms typically shake out pretty similarly, and if you've got a favorite partner in the group of prospective buyers, you can usually get those terms to the right point so that you feel good about it. But I would say most of our clients make the decision at the end of the day on, okay, this is the right group because of the cultural fit. They're the people I like to do business with. They've got the right experience in my space. They've grown businesses like mine before, more so than, there's an extra nickel on the table from another group that is going to provide you just a little bit more liquidity.
Just to sort of to tack onto that question, I'm going to go to the next 3, and you guys can pass the mic down. So you are presented with a process, and you really like the company you're looking at. What's your number 1, 2, 3 characteristics of your business that you like to put forward to say, hey, it's really us over them, and why?
Wow. Okay. I would say, the biggest thing private equity brings, no surprise, is access to capital. So we got tons of capital. So then, as Patrick said very well, it's all about fit. What we say to business owners when we sit in front of them for the first time is all we do is manufacturing and distribution. Our entire 36 transaction track record is all either manufacturing and distribution, all in the middle part of the country. So we think we are pretty good at knowing how, we know what we have to pay to buy the company up front or to invest in the company up front. It's what we're going to do after that we can show, demonstrate, and put that executive in touch with many of our other former CEOs and CFOs that we've worked with, who can reiterate how we work with the company and how we add value to the company. And some of it, I think what we've talked about up till now is the ideal of what we want to see on the day we buy the business. We'd love to have an ERP. We'd love to have a CFO. We'd love to have all the market data that has been described by Patrick, but not all companies have it. And as a matter of fact, in my experience, most don't. They're often using an external financial resource, not audited financial statements. They're running on QuickBooks, not a full or some slim ERP versus full. And so what we try to tell, or what we tell the executive team is, we know how to create value from the inside of the business, and you know how to create value from the outside of the business. You know your market, you know your customers, you know what products you are making that the markets need, and the partnership between we can help you on the inside, make the outside better, faster, with a sense of urgency that you might not have had historically, is what we're really selling to that management team. As well as maybe we're retiring an owner who is holding the reins maybe a little tight, and if they had access to capital and the reins were a little looser, they could run a little faster. So that's and Midwest values. I mean, that's kind of, we invest in Midwest companies with Midwest management teams. Our culture usually fits very well with management teams in that situation.
I guess the way I'd answer this is kind of how we thought about it when we sold our business. We were very specific in that we did not want to sell to private equity, and I'm happy to talk about that later if anyone's interested. But as we thought about creating Bennett Capital, we really wanted to create sort of a hybrid alternative to just being a financial buyer or a strategic buyer. And so we went out and specifically brought in family offices that gave us a long-term hold ability. Someone mentioned a typical PE hold is 2-5 years, then they're going to flip it and they need an exit so they can show an IRR so they can go out and raise another fund, raise more capital, generate more fees, et cetera. It's just a very different vehicle. So our goal was really to create something, if we were going to focus on family businesses, where we really had families investing in families. So all of our capital, we have no institutional investors. It is all families that take a long-term hold mindset. They're generally very knowledgeable about being operators. They're expert in whatever business they owned or still owned. And so when we talk with families, not only are we a family, not only are we operators, not only did we go through a very emotional sale process to a public company, all of our capital base is other people like us who are looking to invest specifically in family businesses. So you're not going to get someone calling you a month after you sell and saying, why didn't you meet this budget number? You need to do X, Y, Z. There's a much better understanding of the way family businesses operate. And family businesses are very different than a private equity owned business. So that is kind of how we try to differentiate ourselves in all the capital that is out there. And then from the investor side, when you sell your family business or you may have liquidity that is sitting there, your private wealth advisor, and there are many here in St. Louis, very good at advising on diversification, markets, bonds, all that. They're not probably the best at saying, hey, you should either do this direct investment in a private company that's not liquid or not. And so a lot of our families look to us to manage that, and they get access to these deals. They can pick and choose if they want to invest or not. They can be active, they can be not active. It's really up to them. And so as we look to acquire or invest in businesses, That's what we do. The first business we ever bought was the 5th largest distributor of Goodyear tires in the country. Company founded in 1919, so right after World War I, 100-year-old family business. It really mattered the culture and the value that we were going to bring. So we had a number of people that had been either in the tire business or bought a lot of tires, and they were hugely instrumental in us growing that company. So that's how we look at it.
You know, Adam really just nailed it from the Hermann perspective, and probably for a lot of family offices. At Hermann, our 3 values, which were originally placeholders when this family office was set up 5 years ago, became permanent, and that is family, finance, and fun. And so when we look at an opportunity that comes in, it's often from a trusted resource, somebody like Bennett Capital, who says, hey, we need a little bit more to get this deal done, and do you want to close with us? So we'll co-invest with people. We'll have industry expertise in a few different areas, and so that is where we can go deep and look to put money to work. But if it's an opportunity, and this next category drives people like Patrick nuts, or would say, let's not spend time there, is if it's an industry we don't know anything about, and there's not a why Hermann factor, which we call it, we score, can we add value, can we make a difference, do we know people here? If you score low on the why Hermann, it's not the deal's dead necessarily. The relationship and those core values can get us comfortable with it, because we do want a diversified portfolio. But for us, family, finance, and fun means family, people we invest with. It needs to be a trusted relationship, and we want to do business with people we want to spend time with. Finance, we have to make money. That's why everybody's here. And fun, how we translate that is transparency. It's not transparency and trust. It's not, like Adam said, beating people up for missing a number. It's having open communications, bad news traveling fast. We're a holding company. We have 80 investments, and we have an investment team of 6 people. And so we can't get into the weeds, or if we are getting into the weeds, that's a problem. We try to be helpful where we can, but back to Paul's original question of, what's a good deal look like, or how do we size something up immediately? It's, do we have industry expertise? And if not, is there a trusted relationship here? And if the answer to that one's no, we can still build that. Opportunity we looked at just a month ago, we told the sponsor, gentleman who's looking to buy a business and trying to put money together to close, said, really like the way you look at this, the way you think about the situation makes total sense. It's just, we haven't worked together before, and you don't have direct experience in this business. Let's see how it goes. Let's get lunch, let's keep the communication going, let's build a relationship over the next couple years and try to get to yes. But again, that's where family offices can be a little fickle and can drive people like Patrick nuts, but that's what makes markets.
All right, well, I've heard the word culture a few times this morning, and so I'm going to, again, just pose this out to the panel. I'll maybe start in the middle, and you guys can decide whether to go left or right from the middle here. But looking from a little bit different perspective, from a culture, when you see companies, and you might say, oh, these guys are going to be great, this is going to be a good fit, and then maybe you find that 1 or 2 things that it's just like, oh, can't believe that they either did this, or I can't believe they did that, or I can't believe I'm finding this now. Just from your think about examples and things you've worked on, what are some of those things that that the audience, you can tell them so that they can say to themselves, do we have that, or maybe it's something we can improve on. Holly, I'm going to start with you.
Thank you. The probably most recent example of sort of a frustration was we had a company under letter of intent proceeding toward, doing our thorough due diligence, as Patrick described. The seller represented their financial statements. The advisor that they were using represented their financial statements. We put our bid as far as valuation based on the financial statements they presented. They did not do what's called a sell-side Q of E, a sell-side quality of earnings, so they didn't hire an accounting firm to evaluate their financials as they were going into the sale process. And that's not super uncommon in the lower middle market. But we would always hire an accounting firm to do what's a buy-side quality of earnings. So we, as the buyer, sent in our accounting firm, and their financials were the EBITDA was probably 30% lower than what they had represented that it was, 25 to 30%. And very frustrating, because now we just spent a lot of money, $50,000, $60,000, $70,000 to do a quality of earnings to find that they had, and they didn't think they were wrong, they were, but so I would say that was, and it kind of goes to Patrick's comments earlier, to be buttoned up with all of your financial information, your market information, your profitability information, and frankly, it was a surprise to them, but had they taken the year or two prior to sale to not even necessarily be audited, although that would have been great, they would have definitely caught it in an audit, to prepare the house. I mean, you wouldn't put your house on the market for sale tomorrow if you've done no cleaning or preparation or whatever to show it best if you were going to sell it. And yet that's kind of what it felt like. They took directly out of their GL, slapped it into the confidential memorandum, and really hadn't scrutinized themselves, or hadn't had an independent party scrutinize their numbers. So I would say the more you can do up front to prepare the company for sale, both with data, financial data, market data, the better off you're going to be. It shortens the process from the time of letter of intent to closing, and time kills deals is a common phrase. But if we spent so much time and had to uncover so much information, it wound up really killing the deal, because they really hadn't prepared themselves for a sale, unfortunately. You can go this way. You're going to take the swan song?
Yeah. I agree with everything Holly just said. There's nothing more frustrating in this way. You don't have to have audited, it just helps with the process, and we certainly invest in businesses that aren't audited. But the QV process that Holly mentioned, I can't tell you how many times that exact example we have, and it's so frustrating, and a lot of times the family it's not their fault, they just didn't know, and they didn't get good advice from their advisor, who didn't take the time to do the sell side QOV first, and just took their stuff out of QuickBooks, slapped it in a book, copied the website, and sent it out. Right? I mean, that it goes back to what I said earlier around what's kind of some of the best things you can do. I mean, make sure you get really good advice, legal, accounting, Patrick's group doing the sell side. So I'd say that is I have multiple examples of that. But back on the culture aspect, that is really, really critical. In our family business, my mother wrote "thank you" on everybody's check. I'm not kidding. Everyone. When we sold to the public company, they were still working for the business through an earnout, and people walked up to my mother and said, "No one wrote "thank you" on my check." Right? They supported the Boys and Girls Club. They were part of the Chamber of Commerce. They bought more Girl Scout cookies than they could eat in a lifetime, right? During the 01 period, when the commercial door industry shut down, they kept everybody, right? I mean, we joked that we had the cleanest toilets and the nicest lawn because people had a job, right? Being part of a family business and that culture, we went to church with the people. We saw them. The people had lives. They had kids to support. They had things. That was very, very important. And so when we go into a business, that is critical. And then in my example of, okay, has that family invested in? Do we need to support that? Or if there's a owner transitioning out, trying to find that right person to come in that shares the same culture with those employees is critical also. And we don't get it right all the time. But if you don't have that right leadership and that culture, it'll kill the business. And that is something that just can't happen. And certainly from our standpoint, because we're investing our own capital, we're investing other families' capital. It's not just some institutional investor. It's very personal for us. And so that culture is very, very key.
My addition would be, again, transparency and bad news traveling fast, and just lay it on the table in the initial process and then post-closing. But at least for Hermann and for this family office, we understand every business is messy, it's complicated, nothing's ideal, and the quicker we can just understand the challenges, the quicker we can figure out if we can put something together. So I'd say there's no shame in saying this isn't working well, or this employee situation's tough, or I'm really concerned about this customer or this supplier relationship. That builds credibility, because we're going to figure it out sooner or later, and there's nothing worse for either side. You get through closing, and then you realize you invested in something that isn't what you expected, and then everybody has a problem at that point. So for us, it's often tell us what you want. We don't necessarily look at like a traditional negotiation maybe, but it's what are you trying to solve for? Is it trying to retain control? I want $5 million personally to, as Patrick said, de-risk or diversify a little bit, and I want $5 million capital on the balance sheet. And here's how much I'm willing to give up. And we can quickly say, yeah, I think it's in the ballpark, or no, but maybe that real estate you own, the manufacturing facility, maybe we can be a lender on that and take a mortgage on that, and that can help achieve some of this. So that's where family offices can add flexibility and say we can do this one smaller transaction and get to know each other over the next few years and see how it works. So to that end, again, it just starts with just be brutally transparent about your business. And if it's not going to work, let's figure it out quickly. But oftentimes it's, okay, yeah, we get it, and here's what we're comfortable, here's how we're comfortable structuring things and putting it to work, and if it doesn't work, no problem, let's keep talking. Yeah.
I needed that time to think about something to say. So on the culture side and the trust of the eventual partner you will have or acquire, I think one piece of advice I'd give is that, again, they're going to ask a lot of questions of you through this process. You're going to have the same question asked many times over by different parties that are involved. We have some of our clients say, well, these guys don't trust us. They keep asking us the same question. I don't know why they don't trust us. And it's not a trust issue. It's a verification issue. Holly's in charge of her firm, but she's got lenders that are partners on the deal that she has to make sure are taken care of. She has limited partners in her fund that invest their money. So she's not going to take a chance on something and risk those relationships by skimping on due diligence. So I just, again, if you can get your mind set going into this process that it's going to be a little bit excruciating from a Q&A standpoint, but that is part of the process, and in the most majority of the cases, it has nothing to do with the buyer not trusting you and doubting what you're saying is true or not. It's just a verification process that is necessary for a successful transaction to take place.
So I can give just a quick example. We had a deal where one of the owners that we represented hid the ball on something and refused to disclose something 2 days before closing. And the private equity firm actually walked away after all their investment. And it was just, in the law firm context, we refer to that as skeletons in the closet. And so every company's got them. And so it's just a matter of how you deal with them and the timing of when you disclose. And so we only have about 5 minutes left, I think, 7 minutes left. Again, any questions from the crowd? I'd love to have a question or two from the crowd if we can get it to kind of wrap things up here. Anybody? Oh, sure. Hold on. There you go. Thank you.
I'd like to hear the panel's thoughts on the impact of private credit on private equity, mezzanine capital, and family offices.
I'll start here and just go on down.
In brief, from an investor standpoint, private credit is really strong right now, and it has been, and so we've liked it as a vehicle to put money to work when we don't have a direct investment opportunity like the folks in this room would be. Everything we can tell, it should continue to perform, really well. If maybe not 12-13%, a little bit lower, but it's to Adam's point before. There's an inordinate amount of capital on the sidelines, and that's one of the newer sources.
I'm a huge fan of private credit. We use private credit in our last business we acquired about a year ago. Just so everyone understands Mark's question, so as opposed to a regulated bank or even a mezzanine fund, that there's certain things they have to fulfill. A private credit fund can really do whatever they want. I mean, they're within bounds. Think of it basically as a private equity fund that does credit.
Debt or loans.
Yeah, exactly. Yeah, exactly. And so from my standpoint, it was really, really advantageous for us to use it. It's expensive. As you said, it can be 12, 13, 14, 15% or more, but I effectively have no covenants. They are not in my shorts. I talk to them sometimes once a month, if that. The first 6 months, I don't think I talked to them. And it certainly helped that the business was going well initially. But it is something where we're a huge fan. Whereas in the past, we would typically use a mezzanine fund, an SBIC mezzanine fund to kind of round out the capital outside of the senior debt. The private credit market for us can lend also at leverage multiples that other people are regulated, they can't do. A lot of the family businesses we invest in are also in the construction space. So we have bonding, we have surety. That gives a lot of lenders, traditional lenders, a lot of indigestion. They just can't wrap their arms around it. So for us and what we do, it's a great structure for us to use.
Private credit is a spectrum. It can be from the first dollar in, meaning competitive with a traditional bank lender and things that a bank can do, all the way to what was being described way beyond what the leverage levels that a bank could do, either by regulation or by comfort of their credit committee. So private credit is a wide spectrum, and there are many, many private credit funds that focus on the top of the balance sheet, like what would be competitive with a senior lender. There's private credit in the middle of the balance sheet, and then there's private credit, literally they'll be the first dollar in all the way down to the equity. They're in effect a buyout fund that's financing the entire balance sheet, and there are thousands of them. We don't use them. We like our traditional senior lender relationships. We bring a senior lender into every transaction where we make an investment, and then Holleway speaks for all the capital from the first sub-debt dollar all the way down to the equity. We feel like it's a less risky strategy. The small businesses that we are investing in, they get wobbly, or they need to make some significant investments beyond. We just don't want the risk profile of an independent third-party mezzanine provider. If EBITDA does go down, either because of investments that you've made or because of market conditions that were unforeseeable, we don't want that credit fund to have their thumb on our neck. So we bring our own sub-debt to every transaction, and we use a traditional lending, senior lender structure above that. So we don't use that. We don't use the private credit market that I just described in our transactions.
I don't know. I'd just add real quick. So I think that for us, that's a really good point. Instead of having two lenders in the mix, getting a senior and a sub, and then our equity coming in, for us, it's a one-stop, effectively a unitranche structure, so that I'm really only dealing with one person. There's no intercreditor. They're the capital. And because of the way they're structured, they're also typically match well with our longer-term hold flexibility. They're not looking for their capital back. My loan is interest only. I can pay it down if I want to, but it's a really flexible, easy structure that ties well with our longer-term family investment hold.
Follow-up question to that. Who do you want to be partnered with on debt when the company has trouble? Are there differences in any of your experiences?
Yes, so that's another good point. I think the private credit fund is far better because when things do go south, you've got competing interests between the senior and the sub, and the senior is going to take precedent at that point, and things can get really, really bad very quickly. And when that happens, you want someone that says, "Hey, okay, I get it. We have a conversation about it. Yeah, you're getting close to tripping covenants, or you do." It's one person versus the senior shutting off the mezz, and the mezz getting pissed, and then everything, no one's working, and everyone is, in their prisoner's dilemma box figuring out what's best for me, and no one works together, and that's a really bad place to be.
We would be exactly the opposite. We would rather work with our senior lender partner. We are the mezz, so if mezz needs to be shut off, it's me And I'm making the decision where it's best for the company to shut off the mezz, keeping our senior lender partner happy, remaining in compliance. I mean, if we can't be in compliance we take low amounts of leverage when we buy the company, so if we can't be in compliance with our senior debt covenants after we've shut off our sub-debt, there's a really big issue going on at the company. In my experience, in 36 investments we've only ever lost one, because we are in control of all the junior capital. At least that's our philosophy, is we want to have control of all. Now, if their cash flow, if things are going well and the company's performing and everything is up and to the right, everybody's happy. It's who's going to do what when the going gets rough. That is why we structure the way that we do. So it's just a different philosophy. But it's part of what makes private equity funds different, and that's why you got to get to know, which partner you're picking, what their philosophies are, how they're going to finance the transaction. I think it's just all part of the getting to know you phase of any partner that you're going to pick going forward.
On that note, Tom, are we ready to wrap up, or do you want to? One more question? Anybody? Well, these guys, you guys are all in and around manufacturing, distribution. You own companies, you've invested in companies, got some manufacturers in the crowd. Just to end on a good note, why manufacturing is good. I mean, we're in the Midwest, regionally. Let's end on a good note, and tell everybody in the crowd why they should be excited about their business.
Like I said, you're the operators, you're the experts. That's what everybody up here is trying to partner with and needs, and so the good ones do really well. It's been discussed. Onshoring is a real thing, and the talent we have here, while there's a lot of challenges with recruiting and retaining people, it's the skilled labor, you can't get it elsewhere. As I'm sure some have tried. You move a plant to Mexico and it takes 5 times the labor content, and it eats up all the savings that was supposed to be there, and then you have the scrap issues and OTD, and so it's a disaster. American manufacturing is excellent. There's strong demand. It's only going to get stronger in the next 4 years, I think.
Yeah, I'm super bullish about the future. I think manufacturing is going to get a huge lift. For me, investing in manufacturing, it's what I grew up in. It's what I know. I like being able to go out and touch and feel the products that we make. I can understand it. I'm generally not the smartest person in the room, so if you start talking about software or technology, I'm the worst person in the world to talk to. I like it, and I think one of the great things about what we do, all of us, is we get to meet really great people, really great operators, really great families, and we learn things every month about new businesses, and this widget does that, and I love that about manufacturing, and it's why we tend to go with what we know well and what we can add value to, right? If you're talking to me, like I said, about a software business, I'm the wrong guy. You should run, not walk, and so we do what we know, and I couldn't be more excited about the U.S. manufacturing opportunity that's coming. So.
Agreed. I've spent a 25-plus year career all in manufacturing. The manufacturing sector is underrated. There's a lot of investors who wouldn't touch manufacturing because they think you can't make good, smart, profitable investments, and I let them think that. That's fine. I couldn't disagree with them more, because I agree. I like companies that make something where you can see it, where you can touch it, where either you're making a piece of capital equipment that's making someone else's company better, or you're making widgets and components and subassemblies and electronics that are making some other person's machine work. And within that realm of making something, there's always ways to try to do it better, faster, cheaper, which is how you're able to then be the most competitive in your particular market. And we have the benefit of seeing 500 companies a year, virtually all of them manufacturers and distributors, and how do we take the best of what we see across a really strong portfolio of opportunities and pick the best companies and then try to help them get better. So I find it extremely rewarding personally, and our investors and our management teams can find it professionally and personally rewarding financially as well.
Yeah, I agree with all that, and I think my 20 years in investment banking, probably the last 3 have been, post-COVID at least, have been, I think, the most promising, at least from what we've seen, looking under the hoods of a lot of different businesses from a manufacturing distribution standpoint, and hopefully, just what we talked about today, that continues on for the near term and hopefully long term. So Kudos to all you that are making it happen out there, and look forward to hearing success stories about your businesses in the near future.
All right, that's a wrap.
All right, nice job, everyone. Thank you so much. Lots of good information up here from lots of experts. Okay, a couple of wrap-up items. Let's see, we want to get a picture of the crowd. Jace, you want to give us a hand with that, please? So our standing joke is if you're running from the law or anything along those lines, just duck your head because this will be on social media.
Thank you.
Great, and if we could get a picture of the panel too, please. Okay, while Jason's wrapping that up, our next event is January 10th of next year. So again, if you go to mmlgroup.org on the upcoming events, you'll see all the dates listed. Please mark your calendars. There's new feedback forms, relatively new feedback forms on your table. They're very important to us, just to get a feel for what you thought of the day and how it transpired and everything along those lines. And then there's a newer section at the bottom. If you're struggling with anything in your business, I think there's about 8 different topics listed down there. This isn't going to be somebody trying to sell you. We're just trying to get you connected to the people that you need to grow your business. So if you could put that down, if you need help with anything, we'd be more than happy to help. There are trash cans and recycle bins. Please do throw your trash away. There's a tote in the back, a little brown tote that says, please return your name badges there. If you could do that, please. And then we have a special guest in the audience today. Robert Briggs, where are you at? If you could stand up. Robert is a black belt lean guy, and he is looking for a new career. So if anybody's looking for a really, really solid black belt lean guy, I won't share the name of the company that he just left, but you have their stuff in your home, I guarantee it. Come see Robert. He's a really great guy. I had the privilege of meeting him on LinkedIn, and he traveled all the way from Kansas City for us today. So thanks for being here, Robert. All right, have a great weekend. Thanks for being here. If there's anything you need from MML, please let us know.